Welcome everyone, I'm Matt Franklin, your portfolio coach, and this is Portfolios 200, Trading Fundamentals. In this lesson, we're going to get more in depth with the math behind asset analysis, index selection, as well as portfolio construction and portfolio optimization. And as you can tell, those are some of the same topics as the first lesson, but we're going to get a lot deeper into how everything works. Starting with asset analysis, we're going to walk you through how the fundamental metrics are calculated, as well as discuss historical time periods and why those matter when calculating your returns. In terms of fundamental metrics, we have 5 metrics that we leverage for grading assets in our system. We use expected return, alpha, Sharpe's measure, Trainer's measure, and then of course we have our overall average. And when we started down this path, we weren't sure what would work for this. We actually took a look at 11 different metrics before settling on these 5, and we chose these 5 because they tested the best over time, and some of them you might even know or have some prior familiarity with. Some of the results you can see here, and if this table looks familiar, it's because we also showed it to you in Portfolios 100, and we wanted to bring it up again just as a refresher. In order to understand these metrics, there are a few other measures that you need to know, so we're going to walk you through those as well. The first 2 are beta and R squared. And in order to understand beta, we need to walk you through what a covariance is. And in order to do that, we also need to walk you through variance and standard deviation. And before we can cover Sharpe's measure and Trainer's measure, we need to walk you through the risk-free rate. So taking a look here, these are all of the metrics that we're about to walk you through. Now in terms of the format that most of this is going to be presented in, we really tried to be fairly consistent on how we presented everything. We wanted you to be able to refer back to these materials and easily find what it is you're looking for. At the top, we have a definition. Now, this is not necessarily what you're going to find when skimming through finance textbooks. We tried to generalize them as much as possible to make them easier to understand. Now, on the left side, there's a box that has the math formula. Then below that, there's a written out formula. So you can clearly understand the formula above it and what it's trying to tell you to do. In the middle, we have a section with some data in order to provide you with an example. And then on the top right, we summarize that example. And then in the below gray box, we include some basic tips for how to use each metric. Let's get into expected return. Expected return is the average return over a time period. With a lot of these slides, you're going to see 2 math formulas in the upper left, one for analyzing a single record, and a second for analyzing a set of records over a time period. Showing you an example, here's the math behind calculating a single return, and from there a single return goes into a set of returns, and then that set gets analyzed as the group, and you come up with your expected return for that time period. That's why changing the historical time period or the set of returns that you're using will change the outcome for each metric. So in terms of our automated test portfolios, that will change the group of stocks that the computer uses during the selection process, and that's how you end up with different recommendations for each of the different strategies. Now on the right side, we included all of the math written out for the final calculation, and we tried to keep these examples fairly simple so you can understand the basic methods. We don't expect you to be able to pass like an investments exam based on these materials. To sum up expected return, this is just a good measure to help you understand assets and their historical price growth. Sometimes you'll hear comments like historical returns don't guarantee future returns. And that's true. Just because the stock you're checking out has had a good expected return, that doesn't necessarily mean that its expected return is going to be maintained. Things tend to balance out over time, so if the stock has had a really good period, that's not necessarily saying it'll go down, but things do tend to be cyclical, so keep that in mind as you're looking at expected returns for your potential investments. And don't get me wrong, it's a great metric and it's commonly referenced by investors, so it's definitely one that you always want to review and consider. Another foundational metric is variance, and with variance, you're essentially taking your time period return, you're subtracting your expected return, and then you're taking the square root of that. And then for the population, you're taking all of your variances and then dividing them by the total number of records minus 1. So here's an example where you find the variance for a time period. And the biggest thing that you need to take away about variance is that it's an identifier of risk. It can help you understand how much risk is associated with a particular asset, which can help you anticipate asset price fluctuations. Standard deviation is another measurement that helps you understand the risk of an asset, and this is essentially how much the asset is expected to move over one time period. To determine standard deviation, you're taking the variance and taking the square root of it. And then again, doing the same thing for the total population, you just take the variance for the population and you take the square root of it. Now, standard deviation reflects how much a return is expected to vary from one period to the next, and it can help you understand how much your assets move within a normal distribution. For example, as you begin your trading day, if you have a standard deviation of 0.6, that means on any particular day that stock will go up or down 0.6%. Now, the reality is it can go up or down much more than that, but that's what you use this for. If your stock gains 2% in a day and you know your standard deviation is 0.6%, then that means it was an unusual gain. And at that point, you should check the news to see if it was something related to the company or the market that created that return. And knowing that will help you understand what to expect next. And in the reverse of that, say you were to lose 2%, then you would do the same thing. Now, obviously, you're a lot less happy because you lost money, but you should look to understand why the stock experienced the loss so that you can make a determination about what you need to do next. Taking all of this to the next level, let's talk about covariance. Covariance is something that we're going to get a lot more in depth with as we talk about portfolio analysis, because this is something that we leverage for the portfolio grades. And essentially, a covariance is how much risk is created by combining two assets together. To get a covariance, you take the return for the time period and subtract the asset's expected return. Then you do the same thing for your index and you multiply those two elements together. You'll do that for each time period. Then to determine the asset's covariance for the population or the total time period, you do something similar to what you did with variance, where you add up all of the covariances and then divide by the total number of time periods minus 1. So, what does all that mean? Well, essentially what you're trying to understand is how two assets interact with one another and how much risk is associated with combining them. So when we get into portfolio construction, we'll get a little more in depth with variances and show you another example with two assets to help you understand how we leverage them for our portfolio grades. The focus there is which assets are contributing the most risk to your portfolio when you're combining them. Beta is probably one of the most important metrics to understand for stock investing. Beta is essentially a representation of how much your stock is going to move in comparison to the market. If the market produces a 2% return and your beta is a 2, that means your asset is going to have a roughly 4% return. Now that might sound good, but at the same time, when the market goes up, it also comes down. So if the market all of a sudden loses 4%, then you lose 8%. So what this means is that you need to pay attention to beta when selecting your stocks, and an ideal beta is typically close to 1, which just means that the stock returns are proportional to the index. Getting into how beta is calculated, you're taking the overall covariance between the index and your asset, and you're dividing it by the variance of the asset for the time period. So it's how much combined risk do you have for every unit of risk that you're taking on. And you want that to be close to a 1-for-1, because having stocks with high betas will create highly volatile portfolios. So by focusing on stocks with a beta close to 1, essentially you're trying to reproduce a market return or basically create your own index fund using the stocks that you're actually interested in. And by doing that, you're also going to have a portfolio that's fairly stable. And by stable, I just mean that it reflects the market return. Now, it's true that if the market is more volatile, your portfolio will be too. But by staying with stocks with a beta close to 1, you're not taking on any unnecessary risk beyond what you would experience with an index fund. And this is better because you get to invest in the companies that you actually want to own. R squared is the coefficient of determination. This is a measure that you can use to determine how much of a return can be attributed to a particular index. In other words, it's a measure that you can use to see how much two things are correlated. And correlation is a fun word for me because it means something mathematically, and I hear people use it in business settings all the time fairly loosely. Well, in terms of stock investing, this is important because you want to understand the movements in your portfolio and what are the main contributing factors. If you have a high R squared, meaning close to 1, then that just means that most of the return for your asset is from the index rather than the asset itself. So in that instance, you might want to pay more attention to what's going on in the market, since the market has more weight in determining the stock's price performance. So getting into how it actually works, you're taking the covariance again, kind of like beta, but this time you're taking the covariance and you're dividing it by the standard deviation of the asset multiplied by the standard deviation of the index. Then you're taking that and you're squaring it. In this particular example, although the data only covers 13 days, you can see that 34.5% of the returns associated with this stock were attributable to the index. And if you have a stock with a high R squared, it's not necessarily a bad thing. It just means that the vast majority of the returns for the stock can be attributed to the index. Risk-free rate is what should be the minimum acceptable return for your portfolio. This is a rate that's typically based on treasuries, like a 1-month T-bill rate. However, depending on the investor that you talk to, they may use a different benchmark. The 1-month T-bill rate is the most common one used by Wall Street analysts, so that's what we use in our examples. And if you want to know the current 1-month T-bill rate, you can go to the U.S. Treasury Department's website, and they post all of the current treasury rates on there daily. On the screen here, we have a snapshot from early 2023, and you can see the rates at that time. And in this example, the data in this table was from 2021 and during the pandemic, when rates were very close to zero. And I'm showing you this set of rates because it's what we use in our next few examples. But using this screenshot from early 2023, 4.23% would be the minimum acceptable return for your portfolio at that time. And if your portfolio is expected to perform worse than that, then logic would push you towards moving your money into the treasury and out of the low-performing stocks. This is what we mean by it's the minimum acceptable return. Because if you can get the return and it's guaranteed through a bond, then why would you accept something less from your stocks? So knowing the current risk-free rate should help you set standards with stock investing and give you some thresholds not to cross when making stock selections. So just because you have an interest in a particular stock, you should always consider the math and if there are better options available. Sharpe's measure is one of the metrics that leverages the risk-free rate. And essentially how it works is you take your expected return for the asset, you subtract your risk-free rate, and then you divide by the asset's standard deviation. So what does that mean? Well, the numerator in the formula is referred to as the risk premium, and that's the premium that the asset is paying you to hold on to it. And since you're taking the expected return and subtracting the risk-free rate, if the risk premium is negative, that's an indication that you should likely choose another option. You can still choose to invest in that stock and it might work out for you. It's just that the math is indicating that the market has better investments available. And that's the same math that they're seeing on Wall Street, so just know that they will likely stay away from that investment, which can stunt market interest and price growth. You have to be careful betting against the math, because if the market starts to move against you, that type of pressure will make prices go down. So getting back to the Sharpe measure, because you're dividing the risk premium or the premium that you get for holding on to that stock by the standard deviation, or rather the stock's risk, what you end up with is referred to as the reward to volatility ratio, which is just a fancy way of saying how much reward you're getting for each unit of risk. And knowing that's what you're looking at, hopefully now you understand why this is one of Wall Street's favorite metrics. Trainer's measure is very similar to Sharpe's measure, except for you're dividing the risk premium by the asset's beta instead of its standard deviation. So by taking the risk premium and dividing it by beta, this metric shows you how much premium you get for each movement in the market. So now your analysis is linked to the market rather than the asset. And because of that, this metric is referred to as the reward to variability ratio, since it's linked to how much you make for each movement in the market. So both of these metrics are really interesting. I like Sharpe's measure to find good, stable investments that you know are performing well over a long time period. And Trainer's measure works really well in identifying stocks that are doing well during periods of volatility and growth. And if the market is growing a lot, it will help you identify those stocks that are typically the reason for it. So don't be intimidated by Trainer's measure or Sharpe's measure. A lot of people will stick to expected return or alpha to select their stocks, which we'll get more into alpha here in a moment. But Sharpe's measure and Trainer's measure are metrics that are very highly touted in the investment community, so learn how to leverage them for yourself and take advantage of what they're telling you. Getting into alpha. Alpha is really the metric that helps you understand the portion of an asset's return that's produced by the asset itself and not the market. Now, there are several ways to calculate alpha. The way that we coach is to take the expected return of the asset and subtract that from the product of beta and the expected return of the market. So when you take beta and you multiply it by the market's expected return, that tells you how much return the market produced. Then you subtract that from your asset's expected return to figure out how much of the total return was not explained by the market movements. In this particular instance, it's saying that 0.556% or most of the return is produced by the stock and not by the market. So this is kind of a unique example because this example only uses a few returns. Most of the time you are using longer return time periods. In this example, what the 0.556% is saying is that the majority of the return is due to the company's actions and not the markets. So alpha is a good measure for identifying stocks that are performing well during periods of growth and economic expansion. Stocks showing good alphas over 90 days or 1 year tend to be where you want to look if you're using this metric for stock selection. And in Portfolios 400, we get more into how each of the metrics performs in our testing and what the results say to do in order to get the best returns for each. The last metric we want to walk you through is our grade rank average. We actually tested a variety of different combinations of the other four metrics, and we even tested other common statistics to see if any of them were worth building grades for and including in the training. And I was surprised because the average ranking of the four metrics actually tested the best. So when I say average rankings, what do I mean? Well, it's the average of the rankings for each of the other four metrics. So we take the stock's ranking for expected return, alpha, Sharpe's measure, and Trainer's measure, which is just how the asset fell within the overall population for that metric, and we find the average rank. Then we take the averages and we re-rank them, and then apply the grading methodology to the new results. So in this example, out of about 11,000 stocks, this stock ranked 3,217 for expected return, 3,287 for alpha, 1,597 for Sharpe's measure, and 5,037 for Trainer's. Now, if you take all four of those and you add them together and you divide by 4, you come up with an average rank of 3,285. And when we do that for every asset in the population and then we re-rank them to arrive at every asset's average rank, this particular asset came in with a ranking of 2,156, which when placed within the new grading scale, gave it a B+. So that's how we come up with the grade average. What we found in testing is that this is actually a really good blend of everything that works well. A stock that has a high grade for the average rank is one that has a great expected return, a great alpha, a high-performing Sharpe's measure, and Trainer's measure. And when you think about it, if you're performing well across all of those metrics, then you're going to find the best performing companies that are out there. And personally, I like to use one of the four main metrics for asset search, and then I always come back and reference the grade rank average to determine if the investment overall is a good investment and worthy of further consideration. The last topic I want to cover in this section is the return time period. This is in reference to the returns used to calculate your metrics and the historical time period that they cover. We tested a 90-day return, a 1-year return, a 5-year return, 8-year return, 10-year return, and a 15-year return. You can see the results here. The foundational metrics make up the red line on the chart, and on average, the 10-year return performed the best. And you can see in the table at the bottom that depending on the metric that you want to leverage for your strategy, the historical time period you want to reference can change. The model that we use to test this creates a pool of stocks based on the ones performing at the top for each metric. Then it limits them down based on the level of risk that they're contributing to the portfolio. So these graphs are showing the performance of those portfolios, and you'll notice that some strategies have fairly high returns. We found that as we dialed in our testing methods, initially the computer would consider stocks with a very high beta, and it's easier for a computer model to stomach that kind of portfolio. Most individuals would not have made the selections that the system initially did, and as we honed in our process for later testing, we decided to make beta another limiting factor for including assets in our portfolios. And you'll notice that as you review the results in later testing, that the returns are much more realistic and reasonable. And we also publish what's in those portfolios in our reporting, so you can know exactly what stocks are behind that performance. Now, with our reporting, our goal is to help you know what's actually working and performing in today's market. So as you go to make decisions about your investments, you have good information available to you for reference. All right, let's take a moment and pause for a question. Which measure represents the average return? Is it A, variance, B, standard deviation, C, expected return, or D, beta? The answer is C, expected return. And hopefully that one was an easy one for you, but if you forgot, don't worry, expected return comes up a lot with investments, so that one will get reinforced over time. The next topic I want to get into is index selection. Now, you might be thinking, why does that even matter? Index selection matters because when you're building stock returns, it can have an impact for certain metrics. For example, it changes your covariance and your beta, and that changes the asset rankings and the grades that we would assign them. The metrics that it impacts are beta, alpha, trainer's measure, and R squared. And if we take you through the math, starting with the index's expected return, the expected return flows into the asset's covariance, down here in the purple box, and then the covariance flows into the beta, as well as the R squared. Then beta flows into alpha and trainer's measure. So as you can see here, by changing the index's expected return, that flows through the different metrics and can have an impact on our stock selections. So what we wanted to determine was, did that make enough of an impact to matter? Since we were already testing a number of other theories, we wanted to go ahead and see if changing the index would impact our overall returns to see if it's worth considering as part of your investment strategy. This here is just a representation of how indexes have performed since the beginning of 2008. And 2008 was a tough year, but markets do experience losses like that, and you need to be prepared for it. That said, over a 10-year period, the market does tend to perform at a high level and has almost always produced positive results. You can see here the market actually performed quite well over this time, and a few indexes performed at very high levels. Mostly those were the ones that were associated with technology stocks, and the indexes that we chose to analyze were the Dow Jones Industrial Average, the S&P 500, the NASDAQ Composite, and the New York Stock Exchange Composite. Over on the side here in the gold box, you can see some other indexes that are popular and commonly used. And as you can see, Dow Jones has other indexes as well. There are indexes for transportation and utilities. As well, they have a total stock market return, which is not referenced as commonly, but you can very easily find it. In terms of S&P, they have a 500, a 100, a mid-cap 400, a small-cap 600, and a super composite that contains 1,500 stocks. We'll get more into capitalization and what that refers to in Portfolios 300. Then there are a few others like the Russell 1000, 2000, and 3000. Those are commonly referred to as well. And then in addition to the NASDAQ Composite, they also have a NASDAQ 100 and a NASDAQ Biotech that focuses on biotechnology stocks. Now here is how the index is performed, and as you can see, for the most part, they're all grouped very closely together. For each of them, they did have the highest return for at least one of the time periods that we tested. We didn't necessarily find anything that really jumped out to us, like the Dow Jones is the highest for year 8, however, it's the lowest for year 1. So really depending on your strategy and what you're looking at, it's possible you'd want to leverage a different index, but the default in our system is the S&P 500, which is the red line on this chart, and as you follow it, you'll notice that it's pretty consistently average. It's not necessarily the highest at each time period, although it is for years 5 and 15, but it's very much in the middle of everything that we tested. So it should produce a return for you that's consistent with the others. Ultimately, we found that changing the index didn't make much of a difference from a stock selection standpoint, and if you really want to review stock metrics where you can change and adjust to different indexes, well, we do have a system that can do that. Our platform and our reporting does not contain that information, so you'll likely have to calculate it yourself if that's something that you want to reference. All right, so let's take a break for another question. I just mentioned this one, so hopefully you'll remember it. What index do we use as the default in our system for calculating our returns? Is it A, the Dow Jones Industrial Average, B, the S&P 500, C, the NASDAQ Composite, or D, the New York Stock Exchange Composite? The answer is B, the S&P 500, and hopefully after going through that section, you understand why we chose that one. All right, on to portfolio construction. And the first concept that we want to cover is portfolio grades. We develop portfolio grades to help people compile and narrow down their stock selections for their portfolio. And the portfolio grade represents the overall risk that each asset is contributing to the portfolio. So if you remember earlier when we were talking about covariances, I mentioned that this is going to come back up when we're talking about portfolios. So let's take another look at how covariance applies here. Walking you through an example, remember that the covariance is just the risk produced by combining assets. When we calculated covariance in the earlier section, it was a covariance between the asset and the index. And this uses the same math, except instead of using the index, you're using another asset. So what you do is you take all of those asset-to-asset covariances and you set them up in a matrix, whereas you essentially use it to analyze all of the assets in your portfolio against one another. Now in the initial example, that used a small data set versus this example on the right, which came out of our system and uses a 10-year history. So that's why some of the numbers here are a little bit different. But what you're doing here is if you go across the top row and add up all of the covariances, you arrive at an end result of 0.284%. And when you compare that to the other assets, you can then determine how much risk that asset is contributing to the overall risk of the portfolio. And seeing your portfolio from this perspective allows you to assess risk levels and make calls about what you want to include. Now, some assets will contribute a lot of risk, some will contribute only a little, and sometimes combining certain ones will actually help you reduce the overall risk of your portfolio. Covariances are a measure that the financial industry is well aware of. A lot of financial professionals have to know how to calculate them in order to get securities licenses, and it's also something that a lot of them are aware of as an option to leverage for portfolio construction. Now, whether they use it or not is not something that I could speak to, but what I can tell you is that they were trained over it, and what we did is we just took it a step further and added another grade here to help make understanding each asset's risk contribution a little bit easier. In an effort to help you understand exactly what we do for portfolio grades, we take all of those covariances and apply the grades based on the distribution of the covariances. In this example, the asset with the most risk had a covariance of 0.825%. As the riskiest asset, our system identifies it with a portfolio grade of R, and that way it's easy to identify the asset contributing the most risk to your portfolio. The other covariances ended up with grades that are much higher, A's and B's. So how did that happen? Well, you can see the distribution here and how most of the covariances fell on the left side of the curve. For the assets, the distribution from least riskiest asset, or the one with negative 0.025%, to the riskiest asset, or that one we just mentioned with 0.825%, becomes the distribution for the other assets, and this shows where they happen to fall, and then the grades are then distributed based on where they fall on that scale. Now, this can get a little more complicated. You might say with this example that you can just drop out that one asset from your portfolio and that will take all the risk away. Well, what happens when you do that? As the portfolio rebalances, it will identify a new asset as the riskiest asset, and you'll see a new set of grades based on the new distribution. And what's important to understand with portfolio grades is that just because you have an A+, or an A in this particular instance, having a whole bunch of them on the high end is not necessarily a good thing. This is just a way to represent risk. And it's true that if you have a whole bunch of assets that are B's or C's, that means that your portfolio's risk is more evenly distributed. You're still going to have an A and an R, but you want to have assets that are fairly evenly distributed. And if you have some that show up as a C or a D, just know that's not necessarily a bad thing. It just means that the asset is contributing more of the risk to your portfolio. And remember that risk in your portfolio is what's producing your return. So it's not necessarily a bad thing to have risk. It's just something that you need to be aware of so that you can manage it. Where it really comes into play for me and how I like to use portfolio grades is when you have a particular number of stocks in mind for your portfolio, and say you start with 5 to 10 more and then use this method to see where the risk is coming from, and then you kind of whittle it down to your portfolio to that final number that you want to include. You can also use it for those instances when you have a stock in mind, but when you go to add it to your portfolio, you find out that it doesn't interact well with some of the other assets that you already have. So what this allows you to do is try out some other similar stocks, maybe stocks in the same industry, to see if there are other options that are actually a better fit for the assets that you already have. This can be a really powerful tool when you leverage it properly. It's just something where I really wanted to walk you through the math behind how it works, so you have a clear understanding of what's going on here. That way, when you're testing things out on our website and everything is changing, you know why. Taking a moment for another question. This topic we've talked about a few times, but it's worth reinforcing again. What is a covariance in basic terms? Is it A, the risk of an asset, B, an asset's market risk, C, how much risk is produced when you pair assets together, or D, how much return is produced for each unit of risk? The answer is C, how much risk you produce when you pair assets together. In terms of the other answers, the risk of an asset is the variance, the asset's market risk is beta, and how much return you get for each unit of risk is Sharpe's measure. Portfolio optimization is likely something you've heard of, or you may have heard the term optimize and wondered what it really meant. So that's what we're going to get into next. At this point in the process, assume you've selected your stocks, you've put them into your portfolio, and now you're ready to optimize your portfolio. So what does that term even mean, and what sort of math is going on behind the scenes? A lot of trading firms today have optimizers integrated into their trading platforms where you can just go and click a button that says optimize, and then it'll tell you how to set up your portfolio. And if you don't use a major firm's trading platform that has something like that, there are a bunch of apps and stuff out there that can help you do that. What I want you to walk away with, though, is what the term optimization actually means. And in this example on your left, you'll see a stock portfolio as well as a risk-free portfolio. So that is not only an optimized portfolio, but that is a portfolio that's been optimized and had risk aversion applied. Risk aversion, in case you forgot, is just when you're breaking your investments into risky and risk-free portfolios. And portfolio optimization, however, is about finding the optimal portfolio and splitting up your risky portfolio in a way that aligns with the best historical result. So how exactly does it do that? Well, what the computer does is it creates thousands of different portfolios with random weight sets and tests them using historical data to determine which one produced the best return while taking on the lowest amount of risk. So essentially, the computer is looking for the portfolio with the optimal slope on the capital allocation line. But before I start to confuse you with all these terms, why don't we walk through an example? Now, here are a whole bunch of portfolios that our system generated for this test. In our tools, what we do is generate 5,000 unique portfolios every time the optimization button is clicked. The 5,000 portfolios are sets of random weights for the quantity of assets that you have in your portfolio, and the weights are then applied to the assets that you have and tested to find out their expected returns and their risk levels. In this graph, you have your expected return on your vertical or your y-axis, and then your risk is on your horizontal or your x-axis. If we were to graph all of the different portfolios, this is what a sample of them would look like. The dots that are colored blue are then referred to as the efficient set, which are the portfolios where the capital allocation line slope is positive. So these are the efficient portfolios that you would want to consider. And before we get more in depth, I just want to point out this portfolio number 1 down here in the orange circle. You can see just below that is the calculation behind that portfolio. And in this example, the expected return was a 0.24 and the risk was a 3.8. So that actually produces a negative slope for the capital allocation line, which is why it's orange and not part of the efficient set. At this point, I've mentioned the capital allocation line a few times. So what is that? Essentially, it's a linear projection of how much return the portfolio is producing for each unit of risk. And you're drawing a line from the risk-free rate where it intersects the y-axis to the portfolio. And remember that, like we said earlier, your minimum acceptable return is the risk-free rate. So no matter what, you shouldn't settle for anything less than that return. Those orange dots all produced returns that were below the risk-free rate, which is why they are not part of the efficient set, and we don't consider them for our final weights. There are other options with the blue that have positive slopes, but what we want to find is the portfolio with the highest slope, and as a reminder, the slope for the capital allocation line is the risk premium divided by the variance, then multiplied by the standard deviation. So what the math is trying to determine is which portfolio is giving you the most return for each unit of risk. The portfolio that does that is called the optimal portfolio. And once you've identified that portfolio, then what you do is you go back to the system and refer to the asset weights in that portfolio, which are shown here in the upper left. For the 5 stocks in this portfolio, these were the asset weights from the optimal portfolio. Then what you do is you take the amount of money that you're looking to invest and you multiply it by that weight. That will give you the total amount of money to invest, and from there you divide that by the share price, and that tells you how many shares to buy for each stock. Now that you understand the basics of portfolio optimization, we need to discuss how frequently you should be optimizing your portfolio. What we mean by that is how often you should actually go out to the market and buy stocks or rebalance to your current optimal portfolio. And in order to help you determine that, there are a lot of recommendations made by financial professionals, but we wanted to see what actually worked, so we built some additional tests to see if we could find out. The timing of optimizations that we tested were weekly, bi-weekly, monthly, bi-monthly or every 2 months, quarterly, which is every 3 months, semi-annually or every 6 months, and then annually. Using those time periods, we built test portfolios and compared that to the average return for the S&P 500 over the same time period. And what we found was that weekly, quarterly, and annual did not perform up to the level of the S&P 500, meaning that you could invest in an index fund and produce a better return than what you would get if you were trading your own stocks on a weekly, quarterly, or annual basis. What we found is that weekly is too frequent. It's not long enough to create any value, which is also why we don't believe in day trading. We do cover what we call popularity-based trading in Portfolios 400, which are some of the basics to be aware of, but in general, we don't encourage it unless it's your full-time gig. And if it is, hopefully you're professionally trained, and this training is just helping you build on some knowledge that you already have. Our results show that to capture the highest return for your assets, you should rebalance your portfolio at least twice a year, and if you can keep up with it, you want to do it every month or two. That sweet spot is really in that 4 to 8 week range, although keep in mind that based on the strategy you pick for asset selection, different optimization time periods are recommended, and we'll go through each metric in more depth in Portfolios 400 and just what our testing shows to leverage for the optimization frequency for each. You may recall in Portfolios 100, we got into the topic of risk aversion. Risk aversion is the concept of balancing your portfolio between a risky portfolio or stock-based portfolio and a risk-free portfolio or something that's more low risk like bonds or fixed income products. The important part of risk aversion is understanding what that balance means for you. So how do you figure out what that balance should be? Well, you can take a risk aversion quiz, and that will calculate your level of risk aversion, and it will tell you how much risk you should take on and what that balance looks like for you based on your risk profile. Hopefully you took the quiz after Portfolios 100, but if not, as a reminder, there's a free quiz sponsored by this program over at riskaversionquiz.com. It's only 8 questions long, and all of the questions are situational based, where you answer buy more, do nothing, or sell. It takes about 5 to 10 minutes to take the quiz and get your results. I've taken the quiz a number of times, and on average, I get a score of 14, which is a slightly risk-averse profile. In the example on the screen, this individual scored a score of 13, which would indicate that they should put 54% of their investment in stocks and 45% in bonds. In the previous example, we used a $10,000 portfolio, so let's revisit that and show you what that portfolio looks like when you apply risk aversion. So taking another look, we now have our risky and risk-free portfolios divided according to our level of risk aversion. And from here, we bring in the optimal portfolio to represent our risky portfolio. And for our risk-free portfolio, I'd highly recommend that you talk to investment professionals if you want to consider options outside of bonds or cash. They'll have other products that they can sell you that also fit into that profile, and by allowing them to sell you those products, you might get some free advice on your risky portfolio. The assets shown here for the risk-free portfolio are just done for example, with 40% in T-bills, 40% in bonds, and 20% in cash. We're not recommending that this is the best allocation. We're just providing it as an example. And then for your risky portfolio, you can see that you reallocate the number of shares you purchase based on the new value of the risky portfolio. And this last graphic here is just a representation of your overall portfolio to give you a different perspective on how you've just allocated your total investment. Once you've established your portfolio, while that's a great feeling, many people are stumped as to what to do next. So I want to take a moment to talk to you about rebalancing your portfolio. Earlier, we were talking about optimization, and we said that every 4 to 8 weeks you should come back and optimize your portfolio. So what do we mean by that? Well, if you look at this table, you have your initial optimal portfolio here on the left. It's possible that your original set of weights is still the optimal portfolio. However, at this point in time, since a few weeks have passed by, the values of your investments have changed. And when we compare the current amount of money in the portfolio with the original optimal weights here in the blue section in the middle, it tells us where we should actually be based on the original optimal portfolio. Before you just go ahead and rebalance to that, you want to go back to your optimizer and check again to see if those weights are still the optimal portfolio. And in this example, when we checked, we found that there was actually a new optimal portfolio. So now, in order to move to that from a rebalance standpoint, the yellow section here shows you the amount of money that would need to be moved around based upon the current share price. And that means that this final recommendation section represents the number of shares that would need to be traded. So the recommendation here was to sell 2 shares of the first stock, 8.5 shares of the second, and so on. and that would get us rebalanced to the new optimal portfolio, which is what you want to do to have the best chance at earning the best return based on what's worked historically. Now, obviously, returns are not guaranteed, nothing is, but these are the methods that fund managers leverage on Wall Street, and you should learn to leverage them for yourself. The next question you might have is, what should you be measuring yourself against? And the market's return is generally represented by a number of indexes like the S&P 500 or Dow Jones Industrial Average. Those are always good benchmarks to use. Tracking your performance to indexes will help you know if you're leaving value on the table by not having the right investments, or perhaps you've seen much more value creation, so now you're thinking more about how to protect your gains. So having a benchmark, which could include your favorite investor's portfolio or whatever you want to compare yourself to, that just gives you a good measuring stick to know whether or not you should be happy with your results. Now keep in mind that over a 10-year time period, no one beats the indexes, at least not when managing large amounts of capital. So keep that in mind when you see certain individuals experience large gains when you're not. It's actually pretty rare, so making sure you're using the right comparisons can make all the difference. You want to be invested for the long haul, and that's where these strategies can help you. Before we move on, I just want to go back to this chart once again. Hopefully now you've got a better understanding of asset and portfolio grades and how portfolio optimization works. In Portfolios 400, we'll go through the performance of the different strategies and how each tested, and that lesson will really help to complete the picture here and bring this method together. The other lessons are still important too. They add context to your portfolio's performance by showing you how to research and what to look out for. The time value of money is something that when you're taking finance courses, this is one of the first concepts that they want to talk to you about. And what I found was that I became so focused on this concept that it was distracting when trying to learn other things. So I've put it as the last topic for today as a way to help keep your attention on those other topics. The time value of money is a concept that can help you understand future value creation or interest payments and how much things will cost you over time. And if you're young, it's a fun way to see how money grows over time, and it's a great principle to apply to your investments. You may have heard investors say that compound interest is king, or something to that effect, and really what they're saying is that over time, the interest accumulation on your investments becomes so large that it can cover all of your needs, and in some folks' cases, they can't spend it faster than they can make it. So it's literally how the rich get richer. Of course, it's not as much fun when you're applying it to calculating debt payments, but this is also where amortization schedules come from and how they're built. So in an effort to provide you with a simple example, let's look at how dramatically each path can have an impact on your life. For this example, let's assume you're 24 years old. While this is not an endorsement of either of these paths, we want you to consider the following scenario. When you were 18, you could have gone two different ways. You could have gone to college, maybe have a study abroad experience, and then gone on to grad school, where after 6 years you've earned your second degree, and to keep it simple, you're now $200,000 in debt. And if you're 18 today, this could be very close to the reality that you'll experience. Now, I want you to consider a second path. This time, think about going to a community college for a 2-year degree, then going on and getting an apprenticeship as a plumber or an electrician. Now you have an associate's degree and are a certified skilled trade. After another year or two, you've been able to make some of the purchases that you wanted, so now it's time for you to start putting away your money so you have it for a rainy day and so you can grow it for generations to come. So what do these two paths look like? Well, by looking at this chart, you're probably thinking that the answer is obvious, where one 24-year-old can start putting away money and building wealth, and the other is deep in a hole and just beginning the process of digging themselves out. Which, by the way, was probably a path recommended to them by all of the successful people that they've met so far in their life. So assuming both are seeing 8% interest rates, this chart represents the different outcomes. And as you can see, after 20 years of both contributing $20,000 of payments per year, The one path ends with the individual walking away debt-free, which is a great feat and should be celebrated, but at the same time, the other person is now a millionaire and their money is going to be making them more than $80,000 per year. Now, if you're 44 and looking at this as a millionaire, congratulations. However, if you're 44 and looking at this and you still have a mountain of college debt and you feel like there's no hope, I can assure you that's not the case. You just need to sit down and make a plan of attack. If you don't know where to start, meet with a financial advisor. And keep in mind, this example is over a period of 20 years. It's not a lifetime, so you always have time to get started. The only bad choice you can make is by not investing to begin with. The market is there for you to use, so you might as well get started. Just make sure when you do start that account that you also establish a savings account. Everyone always has those moments where they're in a pinch and you have to have cash on hand, so by doing that, you will put yourself in a position where you aren't forced to sell off your investments, and if you do that, compound interest will do its thing, and you'll be able to capitalize on this opportunity. All right, so how about one last question before we go? This one is important and something that I want all of you to remember. How often should you rebalance your portfolio? A, every day, B, every week, C, every 2 to 8 weeks, or D, once a year? Well, what our testing shows is C, every 2 to 8 weeks. And we'll get more into optimization rates in Portfolios 400, where we walk you through the results of our testing and exactly how these different metrics performed. That's it for Portfolios 200. This lesson was intended to provide you with a foundation for stock analysis and asset selection, a little deeper understanding of portfolio optimization, and also how to integrate risk aversion into your overall strategy. We hope that you come away from this lesson with a better understanding of where asset and portfolio grades come from and what they mean. At this point, we'd encourage you to start building, optimizing, and rebalancing a portfolio of your own. That way you can reinforce these ideas while they're still fresh in your mind. And don't worry too much about building a portfolio with the stocks in it that you want to buy. Focus more on the asset search process and the portfolio building aspects of our tools and learning how that stuff works. We'll have a chance to build a few more portfolios before this training is over, so for now, understanding the basics of how to use the platform is the main focus we'd like you to have when building your first portfolio. Be sure to stay tuned for our next lesson, Portfolios 300, where we cover financial statements and the basics of financial statement analysis. Until next time, I'm Matt Franklin. Thank you for being here, and have a great day.